So when we talk about the valuation of accounts receivable, we're talking about, are we really going to collect these receivables? They're assets, financial assets. We cannot overstate our assets, so we have to have a fairly accurate number of what we really expect to collect. So this brings us to the various methods of accounting for bad debts and expected bad debts. So we have two methods, the direct write-off method, which you may remember from AC 102. This is not GAAP because it doesn't match your revenues with the bad debt expense that goes with it. And it also doesn't state your receivables at their net realizable value, which translates into what you really expect to collect. So direct write-off, this is simply when a customer doesn't pay, you write off the account. So you would debit bad debt expense and credit accounts receivable. You're only writing off something that has actually happened. There's no estimates involved here. And it's okay to use this method when your bad debts are not material. So for instance, for my construction company, most of our houses were, $300,000 to $800,000, and we had all that under contract. But once in a while, we'd have sort of an extraneous $300 we'd have to write off. We used the direct write-off method because the write-offs were such a small percentage, they were definitely not material, and they didn't happen often. So direct write-off method, it's not GAAP, you can use it if they're not material. And if a previously written off account pays, and this is a new account that you did not run into in AC 102, you simply go cash, and then the credit is to uncollectible amounts recovered, which is a sort of an other revenue account. Okay, proper accounting for bad debts for most cases is going to be the allowance method, which you're all familiar with, I hope. So to set it up, you take your results of the accounting period, you look at the receivables that you have on your books, you make some estimate of how many of those are not going to be collected, and you book a journal entry setting up the allowance account, bad debt expense, allowance for doubtful accounts. When you have an actual write-off, you're going to be debiting the allowance because that's your estimated bad debts for the period, and crediting the actual write-off. And then if someone actually pays after you've written them off, you have to reinstate the account, put the receivable back, put that back in the allowance, and then you can record the cash. Otherwise, if you didn't do this part of it, you'd have cash, there's no receivable on the books because it was written off. So you have to put the receivable back on, the allowance back in, then record the receipt of the cash. Okay, so that's your allowance method. Estimating the amount that will be uncollectible under the allowance method. It used to be you may have learned percentage of sales and percentage of receivables if you took AC 102, a few semesters ago. Right now, FASB is recommending just using the percentage of receivables method. So we use either a composite rate, which is we're going to write off 3% of our accounts receivable, or we expect not to collect them, or an aging schedule. So let's just look at a couple of brief exercises here, 7, 5, and 6. Okay, so brief exercise. So we'll look at 7, 5. This company has sales of 1.4 million, and then they estimate that 8% of the receivables will be uncollectible. So you've got your receivables of 250, and so you're going to take the 250 times 8%, and that gives you 20,000 you expect not to collect. Now where you want to end up is accounts receivable less allowance for doubtful accounts of 20 gives you your net receivables, your net realizable value of the 230,000, which would be this minus that. So this is what you want to end up with. What have you got now? Right now you've got 2,400 in the allowance account. So we need a journal entry of 17.6 to get that 24 up to 20. So then you would have accounts receivable 250, allowance for doubtful accounts would be 20,000. You can do it this way. I like to do it with T accounts, where you simply have your $2,400 balance. You want to end up with the 20,000, and what does it take to get there? Visually, it just, you know, sometimes it's a little more understandable. Okay, so if you had, let's say, what are we doing here? In 7.6, okay, here they have just come up with, they say, instead of, it says instead of a $2,400 credit, they say assume it had a debit balance of $1,900. Okay, so what they really mean is, let's do the problem with it like this. I'm sorry, that's not right either, 1,900, okay. Okay, assume we had the allowance for doubtful accounts of 1,900, a debit. In that case, what do you need to do to get to the desired amount? Here, have they done a whole different problem here? Yeah, now they've changed it to 10%. I hate it when Wiley does this. It would be so much better if they just kept with the same problem, but they didn't. Okay, so now they say, instead of an allowance having the balance of 24, we assume it has 19, so I've done that. And then assume that 10% of accounts receivable will prove to be uncollectible. So we're aiming to end up with 2,500 in our allowance account. What does it take to get there? Well, if you've got a debit of 1,900, you're going to have to go 26.9 minus 1,900 would give you the 25. And again, it's easiest to set these up as a T account because then you can see exactly what needs to happen. You've got a debit in the allowance account of 19. You want to end up with a credit of 25. What does it take to get there? Okay, so so I think that's all of those. You should be familiar with how an aging schedule works, and that I would leave you to review from AC 102, because you just have to be aware that the composite rate is, you know, they can say it'll be 8 or 10% of accounts receivable. The aging schedule gives you a much more accurate prediction of your bad debts, because the older, the longer they've been outstanding, the less likely you are to collect them. And so if you're going to set up an aging schedule, it gives you a better estimate to work with. Okay, so that gets us through our accounts receivable.